Hi, everyone. My name is Marty Becker. I'm the owner of Atlas Financial Strategies in St. Louis, Missouri. In this video series, I'm going to show you how I use some of the safest and most reliable financial products on the planet to help my clients achieve 20% more spendable income from their retirement savings. Now, normally, this information is reserved for one-on-one meetings. However, due to the historic number of people retiring every year, I wanted to make this information public to reach as many people as possible and to provide a way that you can come back and watch it as many times as you want. So thank you, stick around, and let's dive into this. Now, you may be wondering, who is this guy telling people what to do with their money? I'm not your typical advisor because my background is firefighting and paramedicine. Traditionally, firefighters, police officers, and other government workers have what's known as a defined benefit pension. A defined benefit pension means you work for a certain number of years, or you reach a certain age, and when you retire, you have a guaranteed monthly income no matter how long you live. It's pretty rare these days, but it used to be the norm. In fact, if you're a baby boomer, there's a very good chance your parents had one of these. In 2008, our pension system at the fire department changed from a defined benefit to a defined contribution, which means your retirement is completely dependent on the stock market. The problem with this retirement system that almost everyone has now is that no one knows what the market is going to be doing 30 days from now, much less 30 years from now. And even at 28 years old, when my pension was changed, I knew that was a flawed system. So I spent the next 7 years researching every type of financial product and strategy I could find, and nothing could give me what I was looking for, which was a guaranteed lifetime income with no market risk. However, one day I came across some information that explained an industry that every advisor and so-called financial expert told me to avoid, and that was the life insurance industry that issues annuities. They told me, don't even bother looking over there. You can't make any money in those products, and those guys are just trying to make a commission. But what I found is that annuities are a very misunderstood part of the financial world. And once I had a chance to speak with an expert, I found that annuities are the only thing that can offer a way to keep my money safe, provide a guaranteed lifetime income, and avoid market risk. That's what I wanted for myself, and it's what I want for my clients. So I have a natural proclivity to think in worst case scenarios, and I think partly due to personality, but also because my background of being trained as a fire captain. When you're in my position, you're constantly running worst case scenarios through your head. For instance, I'll just randomly be driving by a restaurant and I'll think to myself, okay, what happens when Mrs. McGillicuddy runs her Cadillac through the lobby of Red Lobster and there's two people trapped underneath the car? And you'd be shocked how often that actually happens. Because when you pull up to something like that, there's a lot of things you have to assess immediately. And an average bystander would be thinking, we have to get those people out from underneath the car. And yes, that's important, but it's not the only thing that matters. For instance, what about Mrs. McGillicuddy? Is she okay, or did she have a heart attack and that's why she ran the car through the lobby? What about the structure of the building? Did she compromise some type of load-bearing wall when she hit the building? Is there a 2,000-pound HVAC unit above her heads that could come crashing down on top of everyone else who's standing there? These are things that you have to think about when you're running an emergency operation. And you may be sitting there already a couple minutes into this video and wondering, what the hell is this guy talking about? And what does it have to do with retirement planning? The answer is it has everything to do with what we're going to be talking about during this video series. Because the example I just gave you, where everyone is only focused on the people trapped under the car, that's what's known as tunnel vision. It's focusing only on one part of a much larger picture that has several other risks that need to be considered and possibly mitigated. And that's what today's retirement planning has turned into. It's an oversimplified process that doesn't assess all the risks that are inherent when someone transitions from a steady paycheck to living off a big pile of money sitting in a retirement portfolio. And what I see a lot of advisors doing is getting tunnel vision on chasing interest rates for their clients and not assessing all the other risk that they're going to deal with throughout their retirement. In fact, in retirement, ROI no longer needs to stand for return on investment. It needs to stand for reliability of income. The three main risks that most retirees are going to have to face are: number one, withdrawal rate risk; two, sequence of returns risk; and three, longevity risk. Now, in video 2, I'll go deeper into how we handle these risks using a case study with my clients, Mike and Stacy. But for now, let's go through these three risks. One of the biggest and probably the most controversial risk at this point is the withdrawal rate risk. Now, you may have heard of the 4% rule, which means you can take 4% of the value of your portfolio when you retire. The concept was originally presented in the early 90s by an advisor named William Benjamin. Now, Benjamin was talking about how he was running models trying to find an acceptable amount that his clients could withdraw from their portfolios and still have a relatively high chance of not running out of money in a 30-year period. And after running thousands of scenarios using market returns all the way back to 1925, he came up with 4% as an acceptable amount. And then you could take inflation as time went on. So for every $100,000 you have saved for retirement, you can take $4,000 from your portfolio. And that's total before you pay the tax on it. Here's the problem. William Benjamin ran these models in the early 1990s, and we live in a very different world today. Because at the end of the 20th century, computer-generated trading started, and our markets became way more volatile. And in the early part of the 21st century, we lived through a very low interest rate environment. So that 4% rule has changed, and depending on who you listen to and depending on when they said it, sets the bar on what you should be taking out of your retirement portfolio every year. There's a handful of economists that talk about this withdrawal rate issue, but one has been writing about it consistently for a long time. This guy here, Dr. Wade Pfau, has suggested anywhere from as low as 1.5%, but I've never seen him recommend anything higher than 3.5%. And depending on how long you think you'll need your money to last, will depend on what percentage you should take out in the first year of your retirement. Most people will need that money to last anywhere from 30 to 35 years. So you can probably get away with taking 3.5% to start. But here's the amazing thing, and most people don't grasp the gravity of this. Look at the difference between the success rate for a 35-year time frame of taking 3.5%, which has a 99% success rate, to taking 4%. If you take $3,500 for every $100,000 you have saved in your portfolio, you have a 99% chance your money will last 35 years. But if you just take an extra $500 per year, not an extra $500 per week or per month, but an extra $500 per year, your success rate drops to under 93%. And maybe you're okay with that, and that's totally fine. It's your money. You do whatever you want. But I like to use the analogy, if I'm on an airplane and the pilot announces on the PA system that we have a 93% chance of making it to our destination, I'm getting off the plane. So these measurements are that tight. It's crazy. Now, you may be saying to yourself, no, Marty, my advisor said I can expect an average of 5%, so I can easily take 4 to 4.5% plus inflation with no issues. And my response to that is, I don't care about averages at all, because most advisors are operating off of something called Wall Street math. Wall Street math operates on averages, but here's how averages work. If you have $100,000 and your advisor doubles your money and then loses half of it the next year, then doubles it again and loses half again, that actually comes out to an average return of 25%. But your actual return was 0. And that's not counting any management fees that you would have paid during those 4 years. And I'm sure there's people out there that get those statements and you look at them and you're thinking, God, I feel like I'm going nowhere in my finances. And you'd be right if you're just going off your average return. So I don't care about average returns, and neither should you. But we can look at the actual returns over the past 30 years to help us hone in on what to expect. There's a financial research company called Dalbar, and they put out a report every single year called the QAIB report. This report tracks what investors are actually getting over any given time frame. And because we're talking about long-term retirement allocations, we're going to look at the 30-year period here. Now, this is the 2023 report, but regardless of when you see this, I've been reading this publication for about 9 years now, and these numbers do not change that much. So I feel comfortable telling you these numbers are going to be very similar no matter when you're seeing this video. So the actual returns of people who have had their money in stocks, a managed stock portfolio, have had around a 6.8% return, and those with their money in what's called an asset allocation portfolio, so like a 60-40, 50-50 type portfolio, have only had about a 2.5% return over a 30-year period. And guess what most advisors have their retired clients in? A 60-40 portfolio. And you may be thinking, that cannot be right. But once you calculate trading costs, sales charges, fees, expenses, and any other cost that comes with a managed portfolio, it starts to look more believable. But the biggest reason the returns are that abysmal is most people don't consider the constant getting in and out of the market and constantly changing strategies. So when you see these numbers like the S&P 500 doing over 9% for the last 30 years, that's only if you were in the market and stayed in the market, never got out. That would have been your return. But because investors and their advisors are constantly getting in and getting out at the wrong time, the average equity fund investor has only returned 6.8% after expenses, or almost 3% less than what the market has actually returned. Warren Buffett has 2 rules of money. Number 1, never lose money. Number 2, don't forget rule number 1. And when you're constantly taking realized losses, chasing strategies and interest rates, you undoubtedly will break rule number 1. So if the S&P has returns like that, then you could say, okay, I'll just stay in the market and I'll be able to spend a lot more money for my portfolio, right? And the answer is no, you cannot. Because then you would fall victim to the second biggest risk, which is the sequence of returns. The sequence of returns risk is not about the returns that you get, but the order in which you get them. The reason you cannot have all your money in the market when you're retired is because you have to rely on this portfolio to provide you with income in addition to your Social Security. And if you experience early losses in your retirement, it greatly increases your chances of running out of money, because when you're pulling the money out as the market is going down, you're basically stealing the seed that used to plant the next harvest during your working years. So we can look at 2 scenarios using the actual returns of the S&P 500 going back to the year 2000. And let's just say we have 2 people, Jane and Jim. They're the same age, have the same amount of money, and they withdraw the same amount of money every year. Now on the left, Jane had the unfortunate luck of retiring in a negative sequence of return scenario, meaning the market was crashing when she retired, and because she had those early losses, using the 4% rule with a 2.5% inflation increase, she ran out of money by the age of 84 and now has to rely solely on her Social Security for income. However, Jim, on the right side, he had the good fortune of retiring when the market was going up. And look at his portfolio at the same age that Jane was running out of money. He literally has twice the amount of money that he started with, even though he took the exact same amount of withdrawals as Jane. But here's the most interesting thing. All I did was reverse the order of the returns. So these 2 portfolios had the exact same average return. And that is exactly why I don't care about average returns, and you shouldn't either, because no one can control or predict this. Not you, not your advisor. Hell, not even Warren Buffett believes he can time the market. And this particular risk is the very reason you cannot have all your money in equities using the 4% rule when you're retired, which is also why advisors have you in a diversified portfolio, like a 60-40 split between equities and fixed assets. Now, our third retirement risk is the longevity risk, i.e., running out of money before you run out of life. Now, I personally plan for people's money to last until age 100, unless they tell me specifically not to. But there are 3 questions no one has ever been able to answer for me with any certainty. Number 1, who killed Jimmy Hoffa? Number 2, was there a second gunman on the grassy knoll? And number 3, how long are you going to live? Now, we have plenty of speculation on the first 2 questions, but no one, absolutely no one on this earth can answer the third question for you. However, what actuaries can do is take the law of averages and the law of large numbers, and they can estimate with amazing accuracy how many people will live to a certain age, but they just don't know who will live to that age. And when people tell me, I'm not going to live that long, okay, unless barring some type of genetic history or some type of unfortunate diagnosis, we know how long a percentage of individuals will live. So if you're in a 65-year-old married couple, there's a 25% chance that one of you will live to age 98. So if you're not planning until at least age 98, there's a 25% failure rate in your strategy. So what an annuity will do is give you a contractually guaranteed income that will pay you every single month, no matter how long you live. And I'm telling you, ladies and gentlemen, there is no other financial product out there that can mitigate these 3 risks like an income annuity. No other financial product can do it on a guaranteed basis. Not stocks, not bonds, not CDs, not precious metals, not ETFs or mutual funds, not crypto, not even real estate. Because if there was something better out there, then I would be advocating for that. But there just isn't. And this isn't some fad going around, okay? Annuities have been around for hundreds of years. In fact, they've been around longer than that because they can originally be traced to the Roman Empire. And I know that's not really relevant, but my point is, just because you don't know anything about them or your advisor has never brought them up to you before, doesn't mean that these aren't the best solution to mitigate some of the most serious risk you will face in retirement. So in the rest of this video series, I'll show you exactly how we get the most retirement income while protecting and even growing your assets with the Atlas Annuity Strategy that's built on 3 key pillars: maximizing guaranteed income, growth opportunities, and working with the right expert. In the next video, we'll dive into a real-life example with my clients, Mike and Stacy, and you'll see firsthand how we structured their retirement plan to fill their income gap, protect their assets, and maximize growth, all while keeping the risk in check. And if you're serious about building a rock-solid retirement, join me in video 2, where we'll explore how the Atlas Annuity Strategy can work in practice. I'll see you there.